We have Godrej Consumer, which is one of the gainers in today's trading session, and that's largely because of earnings that are not much worse than what the street was fearing or positioned for. We have the CFO of the company, Aasif Malbari, joining in. Thanks a lot, Aasif, for joining in. Now, before we get to the numbers, the most important thing, everyone's talking about the consumer sentiment itself. Can you give us a sense of, how demand has panned out, the urban consumer sentiment in particular? If you could give us a comment on that.
Firstly, if you see our growth numbers in India, we've delivered a strong performance of a 7% underlying volume growth, and we've been able to sustain a high single-digit volume growth. Now, within that, there has been, I would say, some positive green shoots from a rural perspective and a mild kind of stress building on the urban side. Fortunately, they've kind of compensated each other. And in spite of these market conditions, we've been able to stay on trajectory and deliver this performance.
Aasif, what's causing this weakness in urban demand, though?
Yeah, so too early to comment upon it, Mangalam. I think fundamentally we know that sometime back, urban was outpacing rural. We've seen rural step up. There is, I would say, a mild weakness in urban demand. But too early to kind of comment on whether this is going to kind of bounce back or we're going to see a weakness for a period of time. One will have to kind of just wait for a little bit more time to assess the situation.
Right, a little more time to assess the situation. That's the word coming in from a lot of your other peers as well, wondering whether this is temporary or not. But along with numbers, you also called out inflation in palm, especially for the margins in your soap business coming under pressure. How much lower can they go, and what is the range that the street should work with compared to your earlier guidance?
Typically operates between 25 to 27%. That's the kind of range of profitability at which this business operates. We are in the lower leg of the margin. Yeah, I wouldn't want to kind of give a number out in terms of what the pressure would be. A lot of moving parts because the palm oil is moving fairly volatile of late. So would want to kind of, it all depends as to where these prices stabilize. And it's more a lag effect. So we're not really worried because it's a lag effect. Structurally, these margins will kind of come back to those normative range for the India business.
Aasif, can you quantify how much will margin pressure increase by?
No, so, we have already given a guidance that our India business EBITDA typically operates between 25 to 27%. That's the kind of range of profitability at which this business operates. We are in the lower leg of the margin. Yeah, I wouldn't want to kind of give a number out in terms of what the pressure would be. A lot of moving parts because the palm oil is moving fairly volatile of late. So would want to kind of, it all depends as to where these prices stabilize. And it's more a lag effect. So we're not really worried because it's a lag effect. Structurally, these margins will kind of come back to those normative range for the India business.
Just wanted to know about the international business. That's doing well. So despite the domestic margin pressure, international margins have seen a sharp amount of improvement. Do you see more upside there? And what's the kind of top line growth that you're seeing in both Indonesia and Africa from here on?
So I think we're very, very happy in the manner in which our overseas business is kind of shaping up in terms of profitability, both in terms of the growth in absolute profitability and also in the shape of margins which we're able to deliver. There is still a journey to be covered in terms of where we kind of see the normative margins get to. We've spoken about our Indonesia business being at normative margins between around 22 to 24%. We've spoken about Africa margins actually kind of crossing 15% over a period of 2 years, but we've been able to deliver the journey ahead of time. So there is still a distance to kind of cover to where the normative margin should be. So we will make all efforts to kind of get there over the next year or two. Yeah, so I definitely believe that there is still more juice to be kind of brought out in terms of the margin profile and hence the profit growth in the overall international business. As far as the growth goes, which is the second part, Indonesia has been delivering well in terms of growth. We delivered a 7% UVG. We would want to sustain this business at a high single-digit UVG going forward. As far as Africa goes, fortunately, we still remain strong in terms of offtakes and we remain strong in terms of market share. A large portion of the volume decline is coming through by virtue of we correcting the trade inventory, which in a scenario of interest rates being very, very high in parts of Africa, where it's as high as 30%, 35%, is the right thing to do. And we believe that in another quarter or max another 2 quarters, we should be able to complete this journey and then get to an underlying volume growth.
All right, let's talk about the Raymond business that you'll acquire then. On a like-to-like basis, how has the Raymond business grown? And what proportion of the synergies have been recognized and what is remaining?
No, so all the actions in terms of synergy realization has been completed, and we're quite happy in the manner in which we are able to kind of improve the margin profile of the business. So as we speak, the cost base have been reduced, and we're able to significantly step up the investment behind the brands. As far as the portfolio growth goes, this business is growing almost 2x that of the India growth rates. It's a strong double-digit growth which the business is able to deliver. And we are hoping we'll be able to sustain at these higher elevated levels of growth for this business. Most of the actions in terms of rationalizing the portfolio, the tail SKUs, etc., has been completed. So now it's business as usual as far as these brands go.
All right, you will expect to sustain Raymond's growth at elevated levels, which, as you pointed out, is nearly 2x your overall business. But, at a time when domestic pricing pressures are coming in, will you look at cutting ad spends, or will you continue with ad spends even if it's at the cost of margins in the near term?
So, we've called out that for us, it's about tomorrow before today, and it's about building the growth momentum going forward. Even in this quarter, we've ensured that we've kind of held the higher level of ad spends where we are. We've also made certain other investments in terms of rural one operations reach spends, which we are continuing to kind of hold. So given the fact that this margin stress is temporary and the margins will be restored to the normative levels, definitely we will continue to kind of keep the investments on.
Okay, Aasif, final question before we let you go then. In the second half of the year, do we see double-digit volumes in India, or will it still be high single digits?
Yeah, so we've kind of taken a slightly medium to long-term target of kind of getting to a double-digit volume growth. I think given the current market environment, we believe that a high single-digit volume growth, as things stack up now, would be a good performance. And then we will kind of work through to kind of get to the medium to long-term aspiration of a double-digit volume.
All right, we'll take that point. Thank you so much, Aasif, for joining in. In the second half, you will be happy with high single-digit volume growth, some more quarters of margin pressure in the very near future in the Indian business. No problems for international, where there is still some juice for margin expansion. We'll speak to you after your next quarter results as well. With that, we'll slip into a short break. Actually, before we do that, let's get you a few ideas for profit coming in from our colleagues at Money Control Pro. Today, we have Jitendra Gupta joining in with a stock.